All right, everybody. Thank you so much for joining us today for our July monthly investment discussion meeting. I am Michael Schneider, joined by J.R. Gondeck and David Sokolovsky. So guys, this last week and pretty much all of July has been I'd say probably the most interesting month of the year, and this week specifically the most important week of the year from an economic data perspective and from an earnings perspective. It was the GDP data that came out. We're now in a technical recession, but it really doesn't feel that way right now. I mean, JR, can you sort of go into that a little bit, kind of why it might be a recession versus what we're seeing that kind of indicates otherwise?
Well, if you look at the last 3 or 4 months, with all the volatility, the inflation concerns, everything happening overseas, and then the slowdown, the data confirmed a lot of that we saw this morning with the negative almost 1% second quarter GDP. But the reality is when you look a little closer, things aren't as bad as maybe some of the data suggest. And a lot of this that we've been talking about with the market decline over the last quarter or so, we've been trying to figure out how bad of a slowdown is it? And the reality is it's not quite as bad as some of the data suggest overall. And if you look at this graph, David, if you want to walk through maybe the GDP graph here over the last 10 plus years.
Yeah, so this goes back to 2006, and there's essentially the one line, which is GDP in change dollars. So this is in consistent dollars going back to 2012. But we saw that in the first quarter, GDP shrank at an annual pace of 1.6%. In the second quarter, the pace of the slowdown was reduced, so it shrank at a 0.9%. But you really need the National Bureau of Economic Research to officially confirm the recession. But to your point, JR, as you maybe mentioned, things aren't necessarily as bad as they seem, because if you take this as a trend going back the 10 years that we're talking about, or maybe a little bit longer, you see that we're still right in pace on track. You had a large contraction during COVID. You had a very, very sharp recovery, and maybe a little bit of that was overdone with some of the additional stimulus and money in the system. And then you're seeing it's kind of coming back to that long-term trend line, which is healthy.
Well, and to that point, David, if you look, we've talked about resetting expectations with companies and in the last year. Is coming into the year, we expect a little bit of a slower, difficult year, but you didn't expect the sharp slowdown in activity in a lot of ways. And with the benefit of hindsight, we're really just going back to that trend line, as you said. I mean, there's a lot of extra stimulus from the Fed printing a lot of money, and the government stimulus that's been in the markets overall. Now, as we're easing off both of those, we're getting back to the longer term trend line. It was painful over the last 3 to 4 months to reset those expectations. But now, as we kind of confirm the data and look at earnings season overall, as we've talked the last few months, we thought the end of July might be the time to get all of the bad news out. And historically, when you look at media reports and tracking data, by the time we see recession in the headlines like we see today, asset prices are starting to recover. That seems to be the case right now.
Right. Jared, can you talk a little bit about some of the typical things that you see within a recession and why this time it might be a little bit different?
Well, if you just recall back to 2 years ago with COVID, what happened? We had a major slowdown in economic activity, a very quick and vicious recession. What else did you have? A lot of job losses, right? And what's different this time is we're still creating jobs in the economy. And that leads you to believe that this could be a pretty muted slowdown. If you go back to the financial crisis in 08, 09, lots of job losses. And that the labor market continues to be the silver lining, despite the fact, Michael, maybe if you want to go over some of the labor market statistics here, that things are easing a little bit, but maybe silver lining there too.
For sure. So within this graph here, you're looking at the unemployment trend of initial jobless claims. And going back to late February this year, you are seeing that number tick up. But when you look at the long-term average, you see that on average around 220, 225,000 initial claims, and now we're a little bit higher and a little bit above 250. So again, as the economy does slow down, you do expect that number to rise. So what we're seeing now is not unexpected, and I think that's important to note. And when you look at the lowest amount of the initial claims, going back to March, you were below 170,000, which again is much lower than what the long-term average has been. So again, as the Fed works to sort of slow down the economy, sort of bring things back into a normal kind of operating environment, these are the types of moves that are expected and that overall are going to be healthy in the long term for the economy to see.
Let's talk about the job market, David. When you look at some of the slowdown with companies announcing either some layoffs or slowing hiring, what are some of the observations we're seeing initially as things are easing?
Yeah, I think, Jared, kind of like you mentioned, the first thing that we're seeing across a lot of industries, primarily in tech, but other industries as well, is the first step is to kind of maybe slow on hiring. So what companies will typically do is close open requisitions, reduce the amount of people that they're bringing in. Second, they'll reassess kind of where they need some of the folks and maybe reshuffle. And then lastly, the thing that they move towards is layoffs. And we've seen some layoffs, larger companies announcing, particularly in tech again, that a number of their employees are being let go. A lot of times, from the commentary we've read, that's in the recruiting department, right? So if you're not looking to necessarily grow your workforce, maybe that's the first place that you start. But I think the other thing to note is also the types and qualities of jobs. So in a lot of cases, we're seeing, and this is potentially some negative news, is we're seeing high quality, high paying jobs in some cases are the ones that are lost, and the ones that they're going to be replaced with may not necessarily be as good. So the area that we're seeing a lot of growth is particularly the service sector, and that feeds into how we're spending a little bit differently this year than last year. We're seeing the pickup in terms of labor definitely on the service side.
Well, and when you dig into that a little bit, David, with the spending differently, this has been the year of travel, right? We've talked about that. You can see it in the numbers, you see it overall. So it's been a challenge, Michael, right, from some of the inventories of companies of just having the wrong inventory and wrong levels.
Right, because when you look back during COVID, a lot of it was online ordering. So a lot of companies really stocked up on a lot of these basic items. And yeah, as we were saying now, people, they got those things, whether it was a new grill or a new refrigerator, they don't need those anymore. But they want to go and take that trip. They want to go explore. And those experiences are really now where a lot of people are dedicating their dollars. So the question is that once, I guess, how long is this going to go on for, to where people start buying up again at some of these retailers and they kind of can adjust their inventory properly. And then once everybody is done with the travel, and people have already worked on the house, sort of moving forward, when do we start kind of spending equally again?
And when you look at second quarter results, we're still early on in earnings season, but if you look at the credit card results so far, they're detailing exactly what you said, Michael. Overall spending is still very robust. It's just different, and that's continues to be a trend. Now, as we think past Labor Day into the fall, will we get back to that where we're kind of the three of us, maybe one of us takes a trip, one of us, invests the money and the other fixes up a house or does a real estate transaction, that the money is more evenly invested and spent throughout the economy. And that's probably what the forecast will be as we look to the second half of the year and into next year as well.
So I guess, do we think though that the worst is already behind us in terms of this, technical recession, in terms of the economic slowdown, or is there still going to be some bumpiness ahead of it? I happen to think that we could continue to see a little bit more volatility as we get through earnings season. But Jared, what do you think about that?
David, let's talk some alphabet game here. Maybe we talk about shapes, maybe a V, a W, a U. As we're analyzing what's going on, maybe we can cross out a couple of the options. But what are some thoughts with putting all this together ahead?
Yeah, I think like with any standardized test, right, you try to throw out the options that don't make the most sense. So I think, as far as recoveries, a V is unlikely, right? Because one, we haven't necessarily had that massive slowdown. That would be the first part, right? And subsequent recovery as well. But realistically, looking out ahead, you have basically the recovery that's going to be, like you said, maybe hopefully a little bit more even, and companies will have to find their footing, whether they're on the retail space and have to kind of adjust their inventory levels. Because I think, to that previous point, inventories rose across the board. I don't know that companies invested in any particular item, but sales have just slowed. On the other hand, consumers have been spending elsewhere. So as far as coming back to the question on the type of a recovery, it's really looking more like a U. And, for us, what we're looking to avoid is that W. So a potential double dip recession, which is something that we're, very conscious of. But really, I think we've seen the growth that would slow down. Stock prices have come down, which is a leading indicator and something that we see ahead of recessions. We've seen now stocks kind of hover at those lower levels. And at some point, they're going to have to build that base and start slowly recovering from there. So as far as recession shape, it's really looking like a U.
And if you dig in a little bit on the Federal Reserve yesterday and kind of the thoughts of what they've done this year and what's ahead, I mean, clearly the Federal Reserve should have started raising interest rates a year ago, right? But they're playing catch up. So they raised 3/4 yesterday. But it does feel like there's a hint of a pivot in Federal Reserve policy ahead. They're not providing any forward guidance. They're going to be data dependent. So if inflation continues to accelerate, they're going to raise faster. But if the trend of oil prices and the slowing economy overall kind of persists like we've seen over the last 6 to 8 weeks, the Fed could be closer to the end of raising at this point. And that's really the big change, as we look at the horizon at this point, because again, the labor market is slowing, but it's not negative. And again, it's giving some flexibility to Federal Reserve policy to support that U shape. The challenge, as you said, is as you look into next year, there could be a worry of a double dip. It's on our minds as we're looking to invest near term and look on the horizon, because if oil prices come back, if food prices remain reluctantly high, if rents and wages all stay relatively high, it could cause some issues into next year. At that point. So it's, again, at this point, it feels like more of a U, but time will tell. And just like the Fed, we're going to remain pretty data dependent as we're looking to balance and invest ahead.
And as we talk about investing ahead, David, can you talk a little bit about how the rising interest rate environment has altered sort of the landscape for investing in sort of fixed income and other income producing securities?
Sure. So, we've seen it, and this is kind of going back to last year in terms of where interest rates were, and the impact that you see in terms of taking on risk of duration. And this is why we like to be cautious and also not invest too far out into the future if you're not getting compensated for it. So if you look at the blue line, that's a 30-year treasury that was issued at the end of last year in November. If you look at the orange line, that's a 10-year treasury that was issued same day in November of last year. And just the impact that's been felt overall. So as you've seen rates go up, you've seen prices on some of these things come down. On the 10-year, it's down about 11%. On the 30-year, it's down about 22%. And so with rates now being, with us now being in a rising interest rate environment, it does make some sense to take on some potential duration risk, still keeping bonds fairly short, maybe within 8 or 9 years or so, but there's just a lot more opportunity. And you're seeing yields and the amount of money that you can earn in terms of income really starting to move up. So if we take an example portfolio, just in terms of the impact on how much better the financial planning situation looks like today compared to what it would have looked like in 2019. In 2019, rates were hovering around 4% on the types of bonds that we look to buy. So if you had $1 million portfolio, you could generate about $40,000 a year. If you fast forward to today, and we're just in a traditional 60-40 portfolio, so 60% growth, 40% income, that portfolio through 2019 and through today, including the downturn in the first part of this year, would have grown by about 43%. So your $1 million portfolio is now about 1.43. And at the current interest rate environment, which is significantly higher than it was, you can now generate something like $79,000 or $80,000 versus the $40,000 that you were able to generate before. So you do want to stay nimble and still take advantage of opportunities, still have some growth in your portfolio. But during times like this, especially as the Fed was ramping up risk taking and encouraging risk taking, it made sense to invest. And now with a much better environment for savers, it makes sense to rebalance a little bit and look for opportunities in the fixed income market, because that's what's going to drive your retirement income needs, and that's what's going to really make your financial plan work. In our case, we plan very conservatively, so for looking at returns on a financial plan. A lot of times now we're finding bonds that can cover that need. And if you add additional growth on top of that, it makes the financial planning a lot more robust and stronger for families and their individual portfolios.
Yeah, and as you kind of think about what that means short and long term of where things are overall, I've never been optimistic on bonds for the most part in a very long time. And now's the time. We've been talking about this for a month or so on where the opportunities are, and what you've illustrated there, David, kind of is case in point, right? Because of the uncertainty, spreads have widened, meaning you get compensated more for the same risk that you did a couple of years ago. So you're getting paid to go out a few more years. It's a hedge against a slowdown if we get that W-shaped type of recovery. And meanwhile, it can meet the need of what you're looking for and still have that inflation protection with the equity. So it's a great time to rebalance, especially as things have recovered in the month of July and ahead. So with that, we want to thank you for tuning in this month. And again, just like the Federal Reserve, we're going to be very data dependent of how we look at the future and rebalance. But near term, it's good to see the turnaround and look to inflation easing ahead. With that, we want to thank you for tuning in. We'll touch base next month.
Thank you.